Hello, everyone. Today on the final bar, we're going to take a look at a busy week in terms of the Fed meeting, also in terms of earnings. We're going to look at, in a segment called Don't Fight the Fed, focus on the message that we've gotten from the Fed. Not a big change and not a huge market reaction, but what does it tell you overall about the potential strength or weakness for stocks going through the remainder of the year? It's all about interest rates. We'll focus on that chart as well. Also, investor sentiment. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the message that the markets themselves provide. Focus on trends, momentum, price movements, and focus on the key movements all around. I was interviewing Larry McMillan, a famous options author and educator and trader earlier today for our Behind the Charts interview series, focusing on his career and lessons learned. And I was reminded, I asked him what was his one chart would be if he had one chart to analyze the S&P 500, and he very appropriately answered a chart of the S&P 500, which is sort of the Ralph Acampora answer, right? If nothing else, focus on price. Don't worry about all the other stuff. Focus on the trend, focus on the price. The S&P continues to make higher highs and higher lows. Until that stops happening, the trend is positive, and you should think of it that way. And when you look at the breadth conditions, when you look at the sentiment, it'll give you some different ways to qualify or validate or determine how to make sense of those price movements. But at the end of the day, as Larry told me, if the indicators are doing one thing, but the S&P is doing something else, the market is always right. Follow the market. We have some great guests on this show, The Final Bar. We had a couple of really good guests this week, by the way. If you missed them, make sure on our YouTube channel or on StockCharts TV on demand, you check them out. They were pretty well done. Joe Duarte was very good yesterday. Next week on Tuesday, May 4th, we have Jeff Weiss from Clearview Trading Advisors. Wednesday, May 5th, Sean McLaughlin, who's the options strategist at All Star Charts. Finally, on Thursday, May 6th, Xenia Taubina. Xenia is the founder of XT Financial Services. She's a short-term trader focusing on Elliott Wave, which is a very different toolkit and time frame from my own. And I've often learned a lot and grown a lot as an investor by talking to people who are looking at a completely different set of data. So it'll be very interesting to hear, speak to each one of them next week. Also, as a reminder, next Tuesday, May 4th, I will be doing a special presentation called Sell in May, 5 Charts You Need to Review. We're going to focus on the seasonal tendencies. We're entering into the seasonally weakest part of the year, May through October. We're going to look a little bit at the data, what the market can tell us, market history about those seasonal tendencies, but particularly how to think of them this year and focus on the message the markets are providing. We're going to hit on 5 key charts I think you want to have in your arsenal as you enter into this May period and beyond. If you're interested, go to sign up at marketmisbehavior.com/sell-in-May. We'd love to have you join us. Let's continue on with our market recap. So we'll as we've talked about the last couple of days, it's been a heavy earnings week. We had the Fed this week as well. We're going to talk a little bit about the Fed's comments later in the show. And again, particularly from a technical perspective, what the charts are telling us about expectations related to Fed activity or Fed actions. But let's focus on what the markets have done today. Today was a sort of a mini V bottom of sorts. We opened higher, we gapped higher out of the open, traded lower, and actually were net negative around midday, and then went back, round tripped, and closed back at the highs of the day. The S&P closing around 4211. That's up 0.7% from yesterday's close. So for a while, we sort of gave back all the gains and then returned and went higher. We have a lot of earnings coming out this afternoon after the close as we're recording this, including small companies you may not know like Amazon, Twitter, Gilead, NIO, the electric vehicle company. So a lot of stories and themes to pick out. The NASDAQ, by the way, lagged behind the S&P by just a bit. The NASDAQ 100 was up around 0.5%. Mid caps and small caps actually remained flat. They sold off and did not regain the gains that large cap did. So when you look at the recovery phase in the afternoon, it was large over mid and small sort of finished the day flat. The VIX was actually higher today. So don't just think because the market does one thing, the VIX should do the opposite. Although over the long term, that tends to be the relationship. Day to day, you can actually have the VIX go higher because as much as we think of it as a fear gaze, it really is just a measure of volatility, which means there can be a lot of movements still in an up tape, which is what we certainly saw today. Other asset classes very quickly, 10-year yields went higher, sort of a weird day. If you look, the 10-year yield spiked higher, but then most of the day sort of continued lower. So 10-year yielding around 164 here, still pretty elevated from where we've been over the last 6 months. The TLT was down about 1/3%. The dollar was flat. Precious metals lower today with gold and silver both closing down, sort of the opposite of the 10-year yield. You saw the gap down, but then sort of chipped away and moved higher over the course of the day. Oil prices a little higher, which is why energy was one of the top performing sectors today. Cryptocurrencies overall pretty choppy, but net negative. Bitcoin actually giving back a lot of the gains this afternoon and currently trading just below 53,000. Looking at a chart of the S&P 500 again, we're at all-time highs. We made a new all-time high today. We made a new all-time closing high today again. So, thinking back to my conversation with Larry earlier today, when the market's making new highs, the trend is up. Don't think about what could happen, should happen. Focus on following that trend. Don't fight the tape, is what many have said over time. And the trend is undeniably positive. And it's not just the trend in the S&P, I think, that's most encouraging. It's the breadth conditions that are fairly positive. And even though we can have a decent pullback, you don't tend to have a market top with breadth conditions this positive. You can have pullbacks within a long-term uptrend, but it's still a fairly constructive pattern. And when you look at the strength in stocks, I immediately think, as a contrarian, what would I need to see to turn more negative? I actually asked Joe Duarte yesterday, who's our guest on yesterday's show, what would he need to see? He's fairly constructive. He highlighted Louisiana Pacific, one of the railroads, as a decent trade. And we were talking about what would you need to see to turn less positive or at least turn negative. And his comment was, some sort of breakdown, some sort of a break of a key level. When I'm looking at a chart of the S&P 500, you keep bumping sort of a mental stop up as we keep making higher lows. The most recent low is around 4120. That's the low from mid-April. At this point, as long as we remain above that, the cyclical trend, the tactical trend is positive, and overall conditions are fairly constructive. Until that breaks, there's no reason to be that nervous about anything. Below there, you have some more significant lines in the sand, I would say, and we're sort of having a confluence of levels right around here. You have the 50-day moving average currently right around S&P 4000. If you take a trend line from the October low and the March low, that lines up right around with that same level. So overall, if you would get a pullback in the S&P and you would get below 4120, I would immediately be looking at the 4000 level, which would be that support. I think that's a key line in the sand. It would not be surprised if we would hold that on any sort of pullback. We break that, then you have to start thinking a little more deeply about risk management and downside protection and seeing, looking for some further objectives. But at this point, again, overall, the trend has remained fairly constructive. We are going to have a segment in a little bit, by the way, talking about sentiment. So I'm not going to get too much into the sentiment picture yet. We'll break that down a little further momentarily. Let's hit on some sectors, and then we'll look at some of the stocks reporting earnings this week. Communication services, the number one sector. This is Facebook really driving that higher, although there are others as well, to be honest with you. Here's the chart of FB. It traded higher after the close yesterday. It reported after market. And then today you can see the gap higher. You can see this completes a rotation to new highs. What's interesting about a chart like Facebook, and I'll draw the line, actually just use the inspect button here. You can see if you take the high from last August to September, we then came and did not make it back to the high in November. That was sort of an area of concern. We then made a new low, or barely tried to make a new low here in January, but it held. From there, we made a new swing low. We then made a new swing high as we get above some of these levels. And then you can see how we broke out above 300. We pulled back and tested that from above, and we traded below 300, but really never followed through. And now we've rotated higher. So all else being equal, that's a pretty constructive pattern, hitting resistance, breaking out, testing from above, and then resolving higher. So that gap higher is a pretty significant, encouraging signal. That's certainly a buy signal from traditional technical patterns, looking at resistance, breaking out, and then following through after testing it from above. You also had, and I'm sorry, I'm grabbing my paper of a bunch of stocks that reported, so Google yesterday, Alphabet, gapped up on the earnings release, actually traded lower and closed more at the lows of the day yesterday, but today bounced right back higher, up about 2%. So a nice follow through on a key name that reported earlier. Microsoft is another one. Now, this looks a little different. While Google has gapped higher and following through a little bit, Microsoft actually showing a little bit of weakness today, down 0.8%, underperforming the S&P. So that's sort of an interesting one to follow as it trades along the 50-day moving average. That's what's held a number of times in the last 6 months, and that's certainly what I would be looking for. Apple, obviously, another stock coming out yesterday. When you look at the chart of Apple, the problem with some of these charts is they look pretty toppy, and the reason is because this. If you think about how Facebook has now broken out above resistance, Apple actually set a high in September, tested the high in December, had a failed breakout in January, which is a little different, and now we're still not getting back to that level, sort of that 140 level, 138 or so. That's sort of the resistance level from a number of these periods. So Apple is still actually failing to get above that resistance, and until that happens, until you get the upside follow through, it's more questionable, right? It's more discouraging. Next chart, let's look at MasterCard. So this is another one. We had some of the payment processors that we highlighted. A number of these MasterCard yesterday looked like this incredible chart. Visa, MasterCard, PayPal, all rotating higher. MasterCard actually gave it back and more today, down about around 1.7%. We need to wrap it. The other names I would be looking at today in terms of things coming out, Amazon, Gilead, Twitter, all reporting after the close. And we'll see how these things is obviously a pretty fluid situation here. But Amazon, after the report, up about 3.3% so far. We'll look at Twitter so far. Here we go. Symbol summary page will give you the aftermarket closing. So Twitter actually down 0.8% after the close, trading back below 60, which would take it below the March swing low. After things report, it's a great function to go to the symbol summary, type in the ticker. You can see that they're reporting earnings. You can see the actual close and then the after hours trading. Great way to track a reaction to earnings. We need to take a quick break. We'll be back with my next segment. Don't fight the Fed. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So appreciate you joining us every weekday after the close as we focus on the market action from a technical perspective. I always feel like there's so many more charts to get through than we can. But one of the great features of the show is the interactive portion of it. We have a Q&A session called the Final Bar Mailbag twice a week. We'll do another one tomorrow on Friday's show. Shoot us an email with any questions that are coming up in your own process. The Final Bar at StockCharts.com is our email. We're on Twitter at Final Bar SCTV. On our YouTube channel, just put a comment below the video that you're watching. We'd love to answer one of your questions on our next mailbag segment on Friday. Also, as a reminder, go to StockChartsTV.com, use your email, set up a free account, and you can start watching our great content immediately. We're also on all the app stores. Just search for Stock Charts TV on demand. We're going to continue on with the show today with a segment called Don't Fight the Fed. This week has no shortage of potential catalysts. We've got a lot of earnings, and as we're getting ready for the talking about the Fed here, there's a reason why we focused a lot on earnings and just a little bit on the Fed, because that's essentially the market impact that we've seen. I would argue this week has been a lot about earnings reaction and how stocks are reporting. This has the potential for stocks like Alphabet to gap higher. It also has the potential for stocks like Twitter, from what it looks like we're seeing here, to break down. If Twitter trades tomorrow where it's trading today in the after hours, that would actually put it right at or a little bit below the March low, which would confirm a lower high and confirm a lower low. That is not an ideal setup. From a technical perspective, that's starting to look more like Eli Lilly, which we highlighted earlier this week as one of the breakdown charts out there. So certainly be watching that into tomorrow. When we're talking about the Federal Reserve, there's a number of things, and it's often been said, don't fight the Fed, right? The goal is to, don't fight against the machinery of the Federal Reserve to do to the stock market what they want to. And, was there a lot of impact from this week's meeting and this week's comments from Chairman Powell? Not really. You can see, I think the story has been more about earnings and elsewhere. However, what you are seeing from looking at the 10-year is a rotation from, we've had a long-term uptrend in rates. We've had a pullback to an ascending 50-day moving average. And the comment I've been making to all of you is that as long as we remain above the 50-day, which we so far have done, as long as we remain above 1.5%, which is that last Fibonacci support level, overall, I think this is still setting up to show higher rates. And what you did continue to hear, I don't think this is anything different, but continue to echo, it certainly sounds like the Fed is not looking to take any significant action until we get higher. I think 10-year yields could go to 2% plus, and you're not going to see a big change in what they're doing. That means there's no real ceiling to rates. There's no real floor to bond prices. And just as it's been said, on the chart of the 10-year yield, don't confuse the top of the page with resistance. Just because it's gone up a lot in the last year doesn't mean it can't continue to go higher. Same thing looking at the TLT. When we're thinking about bond prices have been coming down here for the last 6 months. We've bounced off of a pretty key support level. This is on the TLT, the low from from end of 2019, September, November, December lows. We came back to that same price level, which makes perfect technical sense, given a bullish divergence of higher momentum lows right at previous price support. That's a perfect time, an ideal time for prices to bounce off of it. The question now is, was that the bottom? Was this the finding of support before the rotation higher, or is this a quick counter trend move before the move lower? Given the comments from the Fed that were really just unchanged in terms of their willingness to see rates go higher, given the fact that the RSI on the TLT actually topped out below 60, which is more of a bearish phase. If you look back for the last 6 months after the August peak, the RSI has never gotten above 60 as the trend has been down. That's characteristic of a downtrend. You never on the little balance, the bear market rallies, you don't get above RSI 60. That shows you that overall the momentum is still very weak. That's what happened a couple of weeks ago. So overall, I think this is still setting up for lower bond prices, higher bond yields. And the question there is, what does that mean? So this has implications for a number of different things. I'll try to hit on a couple of them actually from the Mindful Investor Live chart list. We usually go through this on Fridays, but why not go to it today? So this has implications for a couple of different things. One would be growth versus value. Higher rates is going to be better for the value, type industries, the cyclicals versus the growth industries like tech and others. So you have the ratio that's been rolling lower in the last 6 months. This essentially looks like the chart of the TLT. You've bounced higher. And now I would not be surprised if you see a rotation back lower, which would be favoring value stocks over growth stocks, where that might start to come up. I don't know if I have, I have that in a different chart list. That's actually, here we go. How quickly can I use the chart list portion of StockCharts? Hopefully pretty good. I have a whole thing on ratios right here. And one of the ratios I have is looking at financials versus some other things, financials versus tech. This is a good one to look at. So this essentially looks like a chart of the 10-year yield, the TNX. This is the ratio of the XLF, the financial sector, versus the XOK, the technology sector. And you can see, and if I back this out 20 years, you can see a huge downtrend as financials overall have been underperforming technology. But look at, since the September market high, look at how that completely changed. And you've seen this ratio make higher highs and higher lows, indicating a rotation into financials and away from technology on a relative basis. I think we've pulled back now, and similar to what we saw in January, so I pull back in that ratio before a move to new highs. And my expectation, just given the technical configuration, higher rates, outperformance of financials, energy would be in that bucket as well. And when I think of stocks like FANG, Diamondback Energy bouncing off a 50-day moving average, it starts to feel together like you're seeing this rotation back into the value-oriented spaces. What's interesting about everything I just said is then you look at the chart of Alphabet, of Microsoft and others, and they're actually doing okay. Microsoft would actually be, most likely be coming down from here. Apple would most likely be underperforming for a while. That could certainly happen given some of the concerns that we have on those charts that I discussed earlier, that basically they've hit resistance and have met their match so far. That is our segment, Don't Fight the Fed. And again, I think thinking of the Fed and the impact of their comments and decisions, I'm looking at a chart of the 10-year yields and then thinking about some of the ripple effects of those comments and those decisions. Our next segment is called Getting Sentimental. So what I like to do on Thursday is focus on investor sentiment. There are a couple different ways you can gather investor sentiment. Arguably the best measure of investor sentiment is with price itself. I think price is a good indication of fear and greed, of euphoria and desperation, all of the yin and yang of investor buying and selling, and what drives those. I think that's reflected in price. The second thing would be things, quantitative statistical measures, things like volatility, the VIX, the put-call ratio, looking at positioning. The third one would be survey data. So price and positioning data tells where people are voting with their capital, right? What decisions are they actually making? Survey data, things like the AAII survey, things like Investors Intelligence, Market Vein, the Daily Sentiment Index, these are all measuring, what people are actually saying. Are you bullish or bearish on this particular market? So by looking at all those together, you can get a good sense of investor sentiment. Let's go through now a sentiment chart list and hit on some of the key messages. As a reminder, this is actually a chart list that's part of my chart pack that's free for StockCharts members. If you want this list of charts, along with pretty much most of the other charts that I show on the show, just go to your dashboard, go to your chart lists. At the very bottom, you'll see a little gray button that says Manage Chart Packs, and you'll see one called the Morning Coffee Routine. You can install that, and you're welcome to all of the charts that I'm showing you here on the show. First chart is looking at the VIX. And again, I'm coming off a conversation with Larry McMillan. We talked a good amount about volatility. Our Options 101 panel we did a couple of weeks ago, we've talked a lot about volatility and what the low VIX means relative to historical trends. And I actually tweeted out last week a tongue-in-cheek comment saying, if basically the VIX is at an all-time low, if you're looking at the last year. If you're looking at the last 5 years, it's, oh my gosh, look how high the VIX is, because it's all relative. The VIX is not specifically bound in any given year. It can have a range and then break out of it. And that's really what we've seen in the last 8 months or so, right? After the market sell off into the March lows, where we had the VIX spike up to, extreme highs, it then settled into a range between 40 on the upside, 20 on the downside. We've now broken that. And in March, you actually finally, at the end of March, went below the VIX 20 level for the first time since the February 2020 market high. We've now settled in a little below there today, settling in, continuing around 1750 or so. So overall, you have a lower volatility threshold than what we've had before. Bottoms in the VIX tend to coincide with peaks in stocks, but it doesn't always happen. And there are times when it's when the VIX can remain at a certain level for quite a while. I point out some of these times in late 2019, for example, where the VIX came down to around 12 to 13 to 15, and then just stayed in that range for months and months. So we could be at a period where we just settle into that particular level, which is where we've been for the last month. But in general, this is thought of as the fear gauge, because if and when the market closes, starts to go lower, you tend to have an increase in uncertainty and increase in volatility. And that's when I think the VIX would be very important to pay attention to. Chart number 2, we're looking at the AAII survey. This is what we usually refer to. What's interesting is, and again, this is individual investors. It's a weekly survey asking if you're bullish, bearish, or neutral on stocks for the next 6 months. A bit of a change in the last week, actually. The last 3 weeks, the bullish indicator had been fairly elevated above 50, and a reading above 50 I've thought of as elevated or euphoric sentiment, right? People are more bullish than they usually are. You're in the top, handful of percent of observations when the VIX is above 50. What happened in the last week, though, through today's report, is it came back below 50. It's around 43% bullish. The number of bears actually increased as well. It's around 26% bears. So the spread between the two came down from around 32% to around 17%. So a bit more of a correction, a downside correction in bullishness, less euphoria than we saw in the last couple of weeks. And it's interesting, as the S&P is making new highs, the AAII survey is not. That actually has happened before, and that starts to look, again, it reminds me of previous tops going into the 2018 January high. You had the market go higher as the VIX was sloping downwards. That is not, again, something like the AAII survey. Please don't ever think that I'm suggesting it is 100%, because if you look here in 2017, you had the market going higher, you had the AAII survey going downwards, but then the market just continued higher for a while. So an elevated VIX, this pattern that looks like similar tops, for me, just tells me to be on warning and to start to look for weakness in price. So again, as long as the S&P remains around, above 4120 or so, that's the low from last week. As long as we remain above the most recent swing high, this sort of elevated VIX doesn't concern me. We start, breaking swing lows. That's what tells you that we're seeing a follow through. It's not just sentiment, what people are saying, how people are voting with their feet. Now, speaking of voting with their feet, let's look at the name exposure index and then the RIDEX flows. This actually combines a little of both. The name exposure index is looking at money managers and how weighted they are to equities. And you can answer 200% long, 100% long, flat 0% equity, 100% short, or 200% short. So it's a little different in terms of how the survey is constructed. You can see in bullish phases, we've had a name exposure index above 100%, which is back where we're at today. So we're actually leveraged long according to money managers. Now, again, that does not 100% tell you that the market's going to top out. We've gone higher in different circumstances with that same reading. However, again, for me, it tells me to be on warning and to look for potential breakdowns, again, keying in on that 4120 level. The RIDEX flows, by the way, continue to be at an all-time low. I've inverted the scale here to be more in line with the chart on the top here, looking at the name exposure index. That very high reading basically is a very low value, telling you individual investors in the RIDEX funds are very bullishly positioned, which is a contrarian sell signal. That's a rundown on the sentiment readings using a segment called Getting Sentimental. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the CRB. It's a commodity index. This is the one that I followed for the longest time. This is when I was first introduced to commodities. I was told to follow the CRB along with crude oil and soybeans and wheat and other hard and soft commodities. Now we have a lot of other things. We have ETFs like the GCC, like the DBC, which we'll often refer to. They're weighted different ways. The CRB is the one I'm going to highlight today. This one, overall, the concern or the challenge of this one is has a huge weighting in energy, right, in oil. So if crude oil is doing one thing, most likely the CRB is going to reflect that. However, I'm noticing the CRB making a new, 1 year, actually multiple year, 2-year high, testing the range that we had in 2018. So the CRB has literally round tripped from the 2018 highs, which is a pretty elevated level relative to where it ended up in the second quarter of 2020. So we have completed that rotation. We tested support and rotated higher. We're making yet another new swing high in the last week or so. So overall, I see commodity prices with the potential to go much further than that. You're seeing some chop today with some of the precious metals lower, but certainly strength in energy. And I think that continued strength in the CRB certainly influences or inspires future strength in the energy sector. Chart number 2 is an illustration that good charts can be anywhere. Don't write off a sector like consumer staples just because it's consumer staples, right? Yesterday or the day before, when I had Todd Sohn from Strategas, I think that was on Tuesday's show, he shared consumer staples looking at the relative performance, and he's absolutely right. On a sector basis, consumer staples have been underperforming, but there are charts like this. I think Brewers may be one of the better Dow groups today, up pretty good. And this is within that sort of group, beverages in consumer staples is Brown-Forman BF/B. You can see this nice rotation higher, testing resistance, pulling back, now breaking higher, about 2.5% up, really close to signaling an all clear move to the upside. And what's interesting on the chart of BF/B, Brown-Forman, is the rotation of a downtrend in relative strength to more of an uptrend in the month of April. I'll be interested to see if that continues to improve. That's a decent chart, holding up pretty well and rotating back to the upside within a sector that's relatively unloved. So in pretty much any sector, I bet I could find a chart that's holding up pretty well. I would pay attention for that. Finally, our last chart is Amazon. Just as a reminder, earnings are all over this week. And I would focus on some of the stocks, how they're leading up to earnings. You have Amazon testing all-time highs, looking in the aftermarket very quickly after their announcement, bounce higher today so far. We'll see if that follows through into Friday to the weekend, but we're testing long-term highs, all-time highs. I'm very interested to see if we can close above those September highs on Friday. Folks, that is our show for today. Thanks so much for joining us every weekday after the close for the final bar. As a reminder, go to StockChartsTV.com, use your email, set up a free account, start watching all of our great content immediately. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.